Hi, welcome to Market in a Minute. As we look out to 2026 and 2027, if the Fed cooperates, we think the fundamentals of the market is good, except for the valuation. And the valuation problem tends to be concentrated in the area that's growing the fastest, and that'll likely start to slow down as we enter 2026 and 2027. We're concerned about right in front of us about the seasonality. Okay, it's hurricane season in Florida, and it's hurricane season for the stock market. We just haven't had a hurricane yet, and we're going to walk through how to protect your portfolio. So there's some ways of doing it, some asset allocation thoughts, and maybe some hedging thoughts as well. So market update, the S&P 500 earnings, we think they're going to grow in 2026 nicely and again in 2027. And it's based upon, the stimulus coming from the big beautiful bill, tax incentives hits for individuals really next year. We'll see that in their paychecks. And then for corporations, you're going to see that capital spending really start to accelerate into 2026 and 2027. The Federal Reserve needs to cooperate here to make all this work. So they cut rates to 4.25 from 4.5, and we think that they're on the path over time to get it down to about 3% as the inflation starts to moderate. All that massive money in money markets is kind of stagnant there. It's sitting there. It's not being a productive asset for the overall economy. As rates come down, we see that money probably flowing back into the stock market. Maybe it's more defensive in nature, but we see it flowing back into equities. Not all of it, but just some of it. The repo market, we discussed this last week. If you didn't see our market update last week, go back and take a look at that. It's the repo market is basically dried up. All the excess reserves are basically out of the banking system. So it's a little bit concerning. The Fed really needs to cut rates to get that $7 trillion in money market funds kind of flowing again. AI spending, obviously that's where all the growth's been. It's adding about 0.5% growth to GDP this year. 360 billion in spending this year in AI infrastructure. That's up 80%. So we think the law of large numbers will eventually catch up with this. We're thinking it's probably going to be 2026, but who really knows? But 2026 seems like it's going to slow down significantly versus what it's been growing at this year. So it won't be such of a large driver of economic growth as a percent of GDP as it was in 2025. Technology, obviously a big part of the S&P. Technology and related, 48%. That's concerning us. NVIDIA, a big weight in the overall stock market. We think that there's competition coming at these guys. Obviously, NVIDIA has the lock on AI infrastructure at this point, but we think there's going to be some companies developing things that are probably comparable and maybe at lower prices. But anyhow, we think that the OpenAI deal that NVIDIA did, investing $100 billion basically to buy the NVIDIA chips, is kind of a sign that they're trying as quickly as possible to lock up this market share. Seasonality, okay. Seasonality in August and September. We expected a pullback. What we've been doing is, as we went through July and August, is to become more defensive. In September, the market was strong. So September, the S&P was up 3.6% in September and up 1.9% in August. We haven't seen the seasonality. There hasn't been a big hurricane in Florida either. Doesn't mean it's not going to come. It just means maybe it's delayed. As you can see from this chart, this is just the Dow Jones, okay? And it's a nice chart. That's why we're showing it to you. It represents the seasonality well. But you can see as you go through August, right towards the end of August, you get this sell-off, and then it continues into September, and then it continues in October at times as well. And then you get this big lift-off towards the end of October for a nice year-end rally. we have no reason to believe that this is not going to hold. It's just probably it's delayed. So as the calendar flips, maybe we get that pullback. Just keep in mind when Micron, MU reported earnings, they had really good earnings, really good forecasts, and the stock went down. So it kind of makes you wonder in these tech stocks how much has already been discounted in those valuations at this point. So our message is to be, cautious of. We wouldn't at all advocate having 48% of your portfolio in technology stocks. The bull case, looking out to 2026, in our mind, is about 7,200 on the S&P. So that's about up 8% from this level, and you can get up, up around four and change in treasuries. So, is that a reasonable play? 2x the return. Probably not, given the volatility of the overall stock market. The volatility is, so much higher for the stock market than it is for the bond market. So maybe 4% looks more attractive. So maybe as we enter October, we're going to see some of the money shift out of the stocks and into bonds. And we have some ideas for that as well for the bond market if you're interested. It seems like retail investors are really driving the stock market at this point. So retail investors typically don't do any sort of valuation work or any sort of analysis that's in depth. They don't listen to the conference calls. They don't look at the valuations of each stock in a particular group. So that's just not being done. So you get these dislocations in a big way towards the end of market moves. The government shutdown, if it lasts a long time, it's going to be a problem. We don't see it at this point as a major market event. Usually it's a buying opportunity if it pulls back on the government being shut down. But at this point, we don't see it as an issue. Other asset classes and risk management. So we had some good questions from last week's Market in a Minute, and we wanted to kind of talk about, the question was, okay, what should I do with my money? I get it, the stock market's expensive. We probably should have a correction, if not bear market, at some point. The fundamentals of the markets are good. So what do I do with my money? And so what we would advocate is becoming a little bit more defensive in nature. So asset allocation. So if you're a 60-40 investor, 60% equities, 40% bonds, pull that back. Pull it to 50% or maybe 40%. If you're a 100% equity sort of investor, maybe you go, maybe you take some profits in some things that have done really well and buy some things that have not done well, maybe look for a rotation. So your asset allocation, maybe, I would push it to be a little bit more defensive. Or you could hedge the portfolio. And we think hedging is a very effective way of being able to participate in the overall stock market. And as the stock market rolls over, you can increase that hedge or put the hedge in place to protect yourself. So using hedges, like I'll give you an example. If you went back to 2008, the last real nasty bear market, okay, 40% drop roughly or more in the NASDAQ that year, and then the S&P 500 was down over that, but recovered some in 08. So, S&P was down about 37% total return in 2008. So we don't want to experience that. So the best way to compound money is avoid these big losses, right? So using a hedge in the portfolio can keep the portfolio flat or maybe not down a whole lot if the markets would roll over. Income-oriented stocks are a good way to invest your money in a down market. That income offsets what you're going to lose maybe on the principal. And then, so we like a number of income-oriented stocks. And then international. So we would not invest in international to get diversification, really. So when the U.S. falls, international stocks also fall in a bad way at times. Value stocks performed really well in 2000 through 2002, really well. It was a good 5-6 year cycle there. We think that value stocks are maybe set up if we have a massive rotation, to do really well. If not, they're a good place to park some money for, until this correction may come, or a bear market may come. Consumer staples and healthcare, that's a prime example in my mind. These are growth companies, but they're valued like value stocks now. They're selling at really big discounts to the overall stock market. We talked about Kimberly-Clark last week, KMB, like that one a lot. Healthcare, there's all sorts of good stocks to buy in that sector. Bonds, my mind, bonds, for long term are not all that attractive, but as a temporary defensive measure, maybe buying, the 3 or 5 year Treasury might make some sense, or park some money in cash might be a good way to protect yourself in the short term. So maybe put 5, 10, 15% in cash at this point, or into those defensive fixed income areas of the bond market. Now, we like baby bonds a lot. So we think baby bonds are a good place to invest, not just to be defensive. Baby bonds can pay you roughly an 8% yield, and we do a lot of work in this area. So 8% on baby bonds for 5 year or less, and an investment grade piece of paper. As you roll down the yield curve, right, you go from 5 years to 4 years to 3 years, provided they don't call it on you. You get a really attractive rate of return with taking very low risk in those securities. So we like baby bonds a lot. In real estate, we wouldn't probably invest in hard assets unless you're very long-term oriented, or maybe for your personal investments, maybe you buy a piece of real estate that's offshore in a nice country, that's on the ocean. We think those probably are very undervalued versus what you can get in the United States. But in general, for your portfolio, what we would do is buy the IYRI. Okay, this is an ETF, real estate ETF that yields about 11%. It's low volatility. I like this one a lot to kick off a nice income stream without having a lot of risk associated with it. NVIDIA, okay, say you have a big position in NVIDIA and you don't want to sell it because you can take a massive tax hit. So what do, right? Okay, there's an inverse ETF on NVIDIA, NVD. Repeat that, NVD. It's the 2x inverse of NVIDIA. Say you have $1 million in NVIDIA. You're fortunate to invest in it, got a huge gain. Now you're getting a little concerned about it. You want to protect that gain. You don't want to see your $1 million go to $500,000, right? So what you do, and you have to manage this. You have to watch it closely. So if you could take some proceeds from something else and buy some NVD. You don't have to hedge the whole thing, but if you would hedge the whole thing, you would have your $1 million in NVIDIA, and you'd have $500,000 in NVD to protect that downside. Or you could do it with some option strategies, but we like that to protect the downside in portfolios where you have an individual stock that has a massive gain in it and you don't want to sell it. Now, the chart to the right here, this is in 2008. We see the QID. This is the 2x inverse of the NASDAQ. Okay, so it was up 141% at one point that year. Okay, so this was a great way to hedge your exposure. And then the QQQ was off about 49% at the low of that year. So if you had, your portfolio was full of NASDAQ-oriented stocks and you wanted to protect yourself, by half the position you would normally use. So you wouldn't be dollar for dollar, you'd be half dollar for dollar. Okay, so if you had $1 million in the triple Q or a portfolio like it, you'd buy half a million dollars to protect that downside. So maybe you need to raise some cash to buy some of that QID, but that's the way to protect your portfolio. So there's some risk of doing this, right? So I have a white paper on my website at PVG Asset Management that we published a year or two ago. It's worth reading. It spells out the risk, how to do it. So if you're interested in hedging on your own, you can go and look at that. Otherwise, our firm specializes in protecting your downside in bear markets. We hate to lose money. We're not saying that we're going to have a massive bear market, but what we're saying is that the risks are high. If it starts to roll over, you want to be defensive. You need a plan of action. So right now, it's probably prudent just to raise some cash, be more defensive, see what October brings. Hopefully, we get a little of a buying opportunity and a nice run through year end. In 2026 and 2027, they look good to us, but we're going to fight that valuation problem that we have in front of us. So the market really needs to rotate to other areas of the market to alleviate some of that valuation concern that we have. Take care.